Thank you, everyone. I'll be talking about regimes in Australian pension fund returns. So I guess you've heard this morning about some more stock level analysis. This is more of actual super fund returns. My co-authors are involved in or have been involved in practice before, so it's heartening to know I'm amongst people who are trying to merge practice and academic work. So this is what we're taking you through. I'll skip through the early slides because it's a bit more sort of traditional academic style information, but I'll take you through it nonetheless, and I'll focus more on the output, the findings, and probably the implications for practice, so I guess that's probably what you're interested in, those practitioners who are here. I and colleagues were looking at this series of returns. It's just a time series of daily returns in our jobs one day, and we were wondering, was that one set of data in a sense? You can see areas here and here and here. And the question that we had in our mind was, if there are subsamples, what does that mean for portfolios? That was kind of the motivation for this work originally. This is just the mind map I go through to connect this particular research down here to the big theory in finance, its foundation. I'll take you through that in slides, but that's just a picture of it. So, you all heard of Markovitz and modern portfolio theory. That's very famous. He won a Nobel Prize for that work. And since then, it's been developed quite extensively, and that's a subset of the list of work that's gone on since. And that's basically looked at improving the original framework. The original framework was quite, there had to be assumptions to make it work, and it had to be simplified. So people have developed it to try and bring it to life a bit more since then. And there are some well-known assumptions that don't quite hold in practice. The first one is normality. So if you ever hear fat tails in financial press, that's what it's referring to, the non-normality of financial time series. So as Granger said there, he also won a Nobel Prize. It was a mathematical convenience that made modern portfolio theory work, in a sense. And research a long time ago, Mandelbrot and Farmer said that there's other distributions that might work better than the norm. There are a range of other assumptions. Single period, we all know that we don't have a single period. Portfolio managers rebalance, they've got a long time frame, multiple periods in that time frame. And stationarity and linearity are further assumptions that don't quite hold in practice. And I guess we, as researchers, like to explore that because it's good and well to have a model, but if it doesn't work in practice, then it can be dangerous. So the classical approaches to dealing with nonlinearity from the literature are jumps. So jumps are described as abnormal variations, discontinuities, if you like, in returns. That's how Merton described it, and a long list of literature is followed as a result of that. So people have even considered portfolio choice in the presence of jumps. An alternative is to say, rather than assuming a normal distribution, we'll assume some other distribution and use that explicitly in our analysis, portfolio construction, for example. So there's been a range of alternatives proposed, and that has been developed as well. So maybe the deficiency of that approach is that no matter what data you look at, it's always got a slightly different distribution, so it might not be a very general approach. The third approach, which we took, was this regimes, because it kind of fitted with our intuition of that data on that first slide, where there was kind of pretty controlled, and then there was just big jumps in volatility. And when I talk about regimes, I talk about subsamples in the larger data set, which aren't consistent with the larger data set or other sort of subsamples in that data set. So regimes, states, all these things are used interchangeably in the literature. And they typically have, which is I think good for people in understanding the work, they have pretty descriptive names. So people talk about a normal regime and a down market regime or a bear market regime, things like that. It depends on the author and their prize. And so for us, it gave us an intuitive explanation. And Hamilton, an econometrician who's quite big in this area, said that it's evidence of non-linearity. So we've established that financial time series are non-linear, and considering financial time series from the perspective of regimes might help us to understand that. And the use of regimes also leads us down the path towards Markov methods. I won't go into a lot of detail on that because that gets very complicated and probably boring too. So regimes and Markov methods are actually quite well established in economics from an econometrics perspective. So the business cycle has been looked at, so sort of dating the business cycle from a sort of expansionary to contractionary type perspective. Financial crises, so when they start and finish, and the effects of government policy. So looking at the effect of government policy on particular economic indicators, for example. Outside of economics, regime or Markov methods have been used very extensively. In fact, this particular approach I'll take you through today actually comes from an area outside economics or finance. So speech recognition is one particular area, signal processing, weather modelling. I even think that missile targeting systems use this sort of technology to work. So it's a methodological approach to the data. I don't impose my prize on the data or minimise those. So I'm not sort of making economic comments, it's just putting the data through a model and coming up with some answers as a sort of precursor to, you know, improving practice. And I want to underline that. This isn't going to be the answer, this will be more of a question. So this is what data looks like through this, how can we move towards better approaches to, you know, portfolio management, trading strategies or whatever. So that's outline of a Markov process. Suffice it to say that you need to assume it for all this to work. I won't dwell on that. As I said earlier, these Markov regime switching models, the first dot point, they're quite well established in economics. That Hamilton 89 paper is the big one, so everyone cites that when it's used in economics. Those latter 2 dot points, hidden Markov models, are pretty much unused in economics and finance, so there'd be a very, very small number of studies that use financial data. Where they do use financial data, it's typically a statistician or a management scientist who says, I need a source of data to make this model work. I'll go to finance. They take the model for a spin, but it's mainly a methodology paper. They don't put a lot of financial insight into the paper itself. So it started off being a methodology style of literature, and now we're heading more towards, I think, a literature that's relevant for financial practitioners, might be able to be implemented. I'll tell you later, but a colleague of mine sent a link to a web page, and hedge fund managers were hiring in this particular area about 5 years ago, and which says to me that they were using this for part of their trading strategies. I'll mention that again later. So the hidden Markov model and hidden semi-Markov model are related. The hidden semi-Markov model is the more general, so the hidden Markov model is a specialised version of the semi-Markov model. And there's very few studies related to finance, and where there is, it's in relation to stock returns typically. So what I did was, from my background, which is investment, superannuation, that sort of area, I took a typical balance strategy from a fund, from publicly available data, and put it through this model. I also did the same thing for a cash fund, which I called active cash. This was the days before the GFC, where cash also had cash-like securities in it, and that included mortgage-backed securities. So cash funds didn't feel very cash-like, if you recall, during the GFC. Sorry. So the idea was, how do diversified portfolios or lower risk portfolios compare with the literature on stocks? So that's the asset allocations included in the left here. That would include cash-like securities. So when I say cash, I'm not talking just bank bills, I'm talking other short-term securities. That is the balance fund asset allocation at a point in time. I accept that that's moved over the course of this data set. So we looked at daily unit prices for 2,660 daily returns. The investment objective was the growth fund, which I call AG fund, had a very typical balanced fund objective of CPI plus 4, and the active cash fund they just wanted to beat bank bills after fees. So the reasons for this study was to consider cash and multi-asset class portfolios using these types of models, and to compare them with what we saw from the literature about stocks. So this is the descriptive statistics. It's very typical. That negative skewness and kurtosis equals non-normality. The fact that that bottom row for both is 0 means that both of these time series are heavily non-normal. So that's the critique of Markovitz holds for these two data sets. That is evidence of nonlinearity. That's autocorrelation of variance, and that is statistically significant up to lag 22. That's the time series of returns. I think it's pretty clear that there might be regimes in this data. In fact, one way that the literature says you can identify regimes in data is by looking at the time series and saying, it looks like there's regimes there, and we can assume a number of regimes based on that. You can see that the cash fund, the left of the two, has some big positives, which is consistent with the positive skewness on the previous page, and the active growth fund, it's got those two volatile periods with a particularly bad negative at the bottom there. So these will show up again, these characteristics in the data. That's the standard academic slide you can't read, and that's it blown up so you can see the tails. So when you hear of fat tails, those little items there are fat tails, the left tail of the distribution. So these are very typical distributions, empirical distributions for financial data. So long and short of it is I ran these regime models for both data sets, assuming 3 regimes, because that's what the methodology told me to do. The AIC and the BIC said 3 was the best for the data, and I'll show you the results. So this is the active cash fund. So where it says empirical, that's the actual total data set. And the 3-state model is here. So if you go along that first row where it says N, add 52, 2403 and 205, you get 268. So that's just dividing the data into regimes. So the algorithm says that data point should be in this regime, that one should be in that regime. And it divides these, summarises statistics for each of these subsets. So the mean and standard deviation for each of those, because each of those assumed states are assumed to be normal in this technique. So the literature shows us that there's evidence of volatility regimes. So this shows up here. So if you compare the state 1 and state 2 standard deviations, there's a difference in standard deviation, but there's no difference in mean. That's just a volatility regime, we call it. The transition probability matrix is really just the behaviour between states. So, for example, that is the probability of transitioning from state 1 to state 3. And on the diagonal, on the diagonal is zeros. The same state transition probabilities are in the bottom table. What that says is that state 2 is most persistent, that's got the highest number. That's also pretty logical given that all the charts show that state 2 is the most common, as does the top table there. So that's the cash fund, and that is the decoded state. This decoded state. So all this is saying is that it's mostly in 2, the middle line, and then occasionally it departs from that. You'll note in this latter half that it actually departs from normal for quite a bit, and you can understand why, because that's the GFC. So if I was to take a data set, I could say, if I was monitoring performance, for example, of a manager, I could say, what's going on in this portfolio, run their returns through here. I could run through the benchmark, I could compare their performance. And I think that's one of the future applications of this is for performance monitoring, particularly with opaque investment structures like hedge funds, perhaps. And also even things like, Bernie Madoff said he was doing a particular type of strategy. A lot of people who looked at his numbers couldn't work out that was what he was doing because it didn't seem to gel. I think this might be an application as well, so sort of testing what managers do. So this is just a summary of the findings. Regime is the most common. Other regimes have slightly higher means, although they're roughly the same, and the standard deviations do vary. So there's evidence in here of volatility regimes. This is the AG fund. Here you see big differences between the means of the different states, which this fits with intuition. So the normal regime would be, you'd expect it to be positive and also persistent. So that's state 2. So it's the most common, it's got a positive mean, and it's got a particular volatility. And then the other states have got negative means. Typically in stocks, you have like a normal market and a bad market, as we all know now. And so that you can see the big jump in volatility, and the mean goes negative in both of those. And this is just one version of a model. You could have one with 2 states and it would be slightly different. I think there are a lot of people who put stock in many more states, so 4 or 6 or something like that. It just ends up being more computationally difficult to do. And so the transition probability matrix is very similar in terms of the findings between both data sets. So state 2 is the most common, and the switches to the other states are obviously relatively infrequent. And that's the hidden semi-Markov model. And you'll see in this data, if you actually look at the x-axis, you'll see pretty much every major event in the market that you can think of in the last sort of 13, 14 years shows up in this. So we were quite heartened that to the day, it seems to pick market events, particular market events. So this last one that was mentioned earlier, that's the flash crash. That's September 11. And so they show up throughout. And I think, as I said, if you're looking at a stock portfolio, you would expect, like an active manager in a stock portfolio, you'd expect to see similar behaviour. And where you didn't see similar behaviour, that would be where you'd start looking, I guess, in your monitoring process. So main findings: regime was the good environment, so its highest mean, it had the lowest volatility. It was the normal environment, what people call normal. The other 2 regimes were bad ones in that they had negative means and high volatility. The regimes were differentiated by both, so as I said before, volatility regimes only occurred for the cash fund. And again, all those events pop up. So World Trade Center, the .com bubble, and the GFC and the flash crash are all here. So this is obviously the GFC. So the findings: regimes seem to exist in both diversified funds and in lower risk portfolios. And I admit that cash fund had stuff that probably ended up being a bit more like equity than they would have liked in that fund. Comparing this work to the literature, it doesn't seem that diversification or risk reduction appears to change regime behaviour very much. There's contributions, minor ones. The association time distribution appears to be data dependent, so you've got to be very careful in the model specification. This is a very simple model. The mathematics in it is on the outer limit of my mathematical skill. I think you'd need someone who's trained in the hard sciences to get this stuff working in the optimal way. Peter Small. So there's further evidence of volatility regimes which is shown in the literature. Both these models are very sensitive to changes in the data, which I think is a benefit in terms of how you might use them. At the time this was published last year, the time we were doing this work, there was no other work in non-equity time series or actively managed portfolios of these two model types. And we don't think diversification protects people from regimes, but people haven't typically taken portfolio construction from the perspective of regimes, which is a potential area for future work on this. Implications for practice, which is, I guess, where we come from in that this is where we want to do financial research that's relevant to practitioners. I actually think it's a pretty good analytical tool for understanding time series. So when we had a risk monitoring process, we used to have the returns come through daily. We used to run some analytics and use those analytics to inform the process by which we followed back and determined whether, say, a large negative return was a function of market movement or whether there was something else going on there. So you could use this for that. It could be another one in the barrage of tests, tools you use. There's a potential use in portfolio management. In fact, I think that it is being used now, in a sense. Not the exact same model type, but it is being used. Mark Kritzman, which some of you may have heard of, his firm Wyndham Capital Management has a proprietary process, and it's based on a paper he wrote called, I think, Skulls and Turbulence or something like that. The technique he used was used by an anthropologist in the early 1900s to classify tribes in India based on the circumference of their skull. And so that's how he picks up, I'm not joking, that's how he picks up different regimes, is by that particular technique, which is well known in statistics. It's an excellent paper. So I definitely think there's potential there in portfolio management. He adds economic intuition, so it's not just a model, put the data through it and pull some lever. He has a way of classifying regimes in an economic sense. So he has expansion and contraction. He's got 4 quadrants, and he makes there's a decision rule. So it's not just running a model and getting some numbers out of it. It's actually there's an economic wrapper around it in a sense. In fact, I think it's integral to it. Quantitative performance monitoring, I think this has applications. So if I was a fund of hedge fund manager wanting to understand what was going on underneath it and I wasn't getting complete look through, then I could take a return series, if I could get that even, and run it against a benchmark or a series of other time series that are known, and you could compare them. And I think that kind of thing might help with things like Madoff type events where a person pretends or professes to be doing something and no one can see that in his returns. And in risk management, like I was saying before, we actually use similar techniques in like exception reporting. So if there's a negative return, you investigate and find out whether it's like normal market movements or whether it's something else going on. And like I said, hedge funds have been hiring in this space, or had hired 5 years ago. They were advertising. So I suspect they're used in some of their sort of quantitative strategies. There's so much more to be done here. This is really, for me, like an opening attempt at using some of this technology in finance. Much to be done in terms of model specifications and how that feeds into practice. Be interesting to work out if you can examine the drivers of regime behaviour. I suspect stock risk has got a lot to do with it, but I think that we need to be able to analyse that better. And trying to work out how you construct portfolios to be, resistant to regime behaviour, particularly the negative sort, and whether things like options, they might help, given their asymmetry, that they might help in building better portfolios too. So that's just a very small list of the things that I can think of where this might be used. So that's it. Questions?